Yes.
Okay. Ladies and gentlemen, may I have your attention, please? Our seminar is about to begin. Please have a nice seat, and thank you very much for preparing yourself to join our seminar. Okay, Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, ladies and gentlemen, and good evening, Professor Terrance, Honorable Dean of Faculty of Economics, Universitas Negeri Jakarta, Mr. Dr. Ari Sabtono, Honorable Head of Management Study Program, Faculty of Economics, Universitas Negeri Jakarta, Mr. Dr. Suherman, distinguished speaker, Professor Terrance Odean, the Honorable all participants of this seminar, students, academics, and practitioners. And ladies and gentlemen, welcome to the International Seminar Series 2022 with the topics Performance of Retail Investors. First of all, there will be an opening remarks from Mr. Ari Sabtono. For Mr. Ari Sabtono, the floor is yours.
Terima kasih Mbak Cara. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Good morning, ladies and gentlemen. The Honorable Speaker Professor Terrance Odean, Professor of Finance at the High School of Business at the University of California, Berkeley. The Honorable Chair of the Management Study Program, Faculty of Economics, ONG. Recording in progress. The Honorable Organizing Committee of International Seminar Series 2022. We respect their lecturer and college students. I am the pleasure of welcoming you to the International Seminar Series 2022 with the topic Performance of Retail Investor. Of the occasion, I would like to thank Prof. Terrance Odean, who has agreed to be a speaker at today's event. Ladies and gentlemen, to achieve more sustainable and inclusive growth, Indonesia has to shift its source of economic growth from consumption to investment. However, Indonesia cannot merely rely on a government investment due to its budget limitation. Investment-led growth requires private sector to play active investment role. The financial sector play a crucial role in strengthening private investment, particularly in mobilizing domestic saving and providing capital for productive investment. Many challenges are facing the development of the financial sector in Indonesia. The performance of retail investor will be one of the sector driving a country's economy. Ladies and gentlemen, I would like to thank Dr. Suherman, the coordinator of the Management Study Program, and of course, the organizing committee of the seminar for consistently hosting the seminar, international seminar. I will also like to thank all the participants of the seminar. Finally, enjoy the seminar. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Pak Ari, for your warm welcome. And before we start the seminar, first of all, I will introduce myself. My name is Titis Fatarina Mafira. I will serve you as the moderator of today's seminar. Okay, ladies and gentlemen, this seminar is organized by Management Study Program, Faculty of Economics, Universitas Negeri Jakarta. And now we already have our notable speaker, Professor Terrance Odean. He is the Root Family Foundation Professor and Chair of the Finance Group at the Haas School of Business, University of California, Berkeley. And he is known for his work on behavioral finance. He received his BA in statistics, his master and doctoral degree in finance, and all of them from University of California, Berkeley. Professor Odean also actively contributes in many reputable journals like a Review of Financial Studies, Journal of Finance, Management Science, and Journal of Behavioral Finance as an editor and also associate editor. He is also an advisory editor of the Financial Planning Review, a member of the Journal of Investment Consulting Editorial Advisory Board, and of the Russell Sage Behavioral Economic Roundtable, and is a Wall Street Journal expert panelist too. And his publication also have appeared in many top-tier finance journals, and in 2016, he received the James R. Vertin Award from the CFA Institute for research notable for its relevance and enduring value to investment professionals. And there is still many achievement, honors, and awards of Professor Odean, which I cannot mention it all because it will be time-consuming. So we know how lucky we are to have Professor Terrance Odean with us today. And please don't miss the opportunity to explore as much knowledge as possible from our notable speaker today. Okay, ladies and gentlemen, before the presentation begins, let me inform you the rundown of the seminar. First, Professor Odean will be invited to present the material for about 60 minutes. And after that, there will be a question and answer session for about 20 minutes, and will followed by the conclusion. And after that, we will take some pictures together before we end the seminar. And during the presentation, please to inactivate your microphone, but please turn on your camera, please. Yeah. And now allow me to welcome the speaker, Professor Terrance Odean, to deliver his presentation. Professor Odean, have you joined us?
I'm here.
Okay.
All right.
Are you ready to deliver the presentation?
Yes, I am. Let's see.
Okay.
Is that sharing my screen?
Yes, I can see your screen now.
All right, perfect. All right, so thank you so much. It's an honor to be invited to speak at your seminar. I'm presenting a paper today, Resolving a Paradox. Retail trades positively predict returns, but are not profitable. This is joint work with Brad Barber, who has been my research partner now for about 25 years, and Shengla Lin, who has been a co-author of mine on a couple of other papers. So it's joint work. Let's see here. So here's the paradox that we are interested in. At short horizons, and by short horizons, I'm talking like a day, a week, a couple of weeks. At short horizons, and maybe up to even a month, the order and balance of retail investors positively predicts future returns. Now, Brad and I and Ning Zhu wrote a paper published in 2008 that documented this. About the same time, Soren Wiedger wrote a very similar paper, and the same result. Camille Zarin-Titman also wrote a paper with a different explanation, but finding the same result. And I'll talk a little more about the details of how these papers are done. So, and there have been several subsequent papers that document this. However, at short horizons, retail investors lose money through trading. And again, Brad and I have written, I wrote a paper as part of my dissertation that showed that. Brad and I have written a number of papers that that document this, in some of these with co-authors, and several other authors have documented the same thing. So the paradox is you can look at the trades of retail investors, you can sort them based on order imbalance. And by order imbalance, I'll show you an equation a little later, but basically it's the number of buys, or the dollar value of buys minus that of sells over buys plus sells. It's a measure of to what extent retail investors are buying or selling stocks on a particular day. In the paper, 2008 paper, we also looked at weekly horizons, and so it can be done at a short term, a daily horizon, a weekly horizon. In this paper, we're looking at daily horizons. So if you sort based on order imbalance, you find that the stocks that were most bought by individual investors go on to earn positive returns over the next short period, let's say the next week. Nevertheless, the investors themselves are losing money. So that's the paradox. And let's see, next slide. So there's a few quotes. Let's see, did I get? So the retail trades aren't profitable. And one of my papers are right. Even when trading costs are ignored, these investors actually lower their returns through trading. Greenblatt and Kalahari write, the least sophisticated investors or households generate the worst performance. Barbara Lee Liu and I write, individual investor trading results in systematic and economically large losses. And a recent paper by Jones, Shi, Zhang, and Zhang, looking at retail investors in China, writes the stock prices of small retail investors the prices of stocks that small retail investors buy experience negative returns the next day, while the stocks they sell experience positive returns. On the other side, you have quotes like from Kanil, Liu, Czar, and Titman, which talks about evidence consistent with informed or skillful trading by individual investors. Burmer, Jones, Zhang, and Zhang, three of whom are co-authors on the Chinese retail investor paper that gets the opposite finding. They say we attribute half of the predictable power of retail order imbalance to potential informed trading. And Kanil, Czar, and Titman write that individuals provide liquidity to meet institutional demand for immediacy, leading to retail investor profits. In this recent paper, it's forthcoming in the Journal of Finance, Burmer, Jones, Zhang, and Zhang ask the question, can retail equity investors predict future stock returns, or do they make systematic, costly mistakes in their trading decisions? And our paper, the answer in our paper is yes and yes. We're basically saying both of these are true. So let me explain how they can be both be true. Suppose that you've got an investor who buys $1,000 worth of stock A, $1,000 worth of stock B, and $3,000 of stock C. Now, let's say that over a 1 week horizon, stock A goes up 1%, stock B goes up 1%, and stock C goes down 1%. Obviously, very stylized example. So the equal weighted return, if you look at the three stocks he buys and equally weights them, the return is 0.33%. However, the actual portfolio had a return of minus 0.2%. So this is analogous, and if you annualize these, that would be an equal rated return of almost 19% and an actual portfolio return of negative 10%. And this gives you some insight into what we find. What we find is that the stocks that individual investors buy when equally weighted do positively predict returns, but the stocks that they trade most actively do very, very badly, and that's enough to drag down their portfolio return. So basically, the individual investor underperformance is highly concentrated in stocks with heavy retail trading. A long-short retail order imbalance strategies. If you go long the stocks that individuals are buying and short the ones that they are selling, and you look at the 10% of stocks with the highest amount of trading volume, the long-short portfolio loses about 15% on an annualized basis. However, if you look at all the other 90% of stocks, if you go long the stocks the individuals were buying and short the ones they were selling, you get a positive return of close to 7%, or a positive alpha of close to 7% on an annualized basis. So the trade-weighted strategies earn negative alphas while the equal-weighted strategies earn a positive alpha. And this has led to these two literatures that are drawing different different conclusions. On top of that, and separate from that, the trading day returns are also negative, with the biggest losses in the stocks that are bought most actively. So the papers on order imbalance that I've talked about, generally speaking, what they do is sort stocks on a daily order imbalance, or sometimes on a weekly order imbalance, and then form a portfolio and start measuring returns the following day. And so that's what I'm talking about here, that where I say, if you do that with the 90% of stocks with the least retail trading volume, it does earn a positive return over the next week. The stocks with the most trading volume earn a negative return, and a larger negative return. But in addition to that, if you look at stocks that retail investors buy, lose money, and they lose the most money when the stock is being traded heavily. Let's see if I can get. So small retail trades perform worse than large retail trades. Why is that relevant? Well, small retail trades tend to be more concentrated than large retail trades in high attention stocks, and they tend to lose more money. So retail trades of under $500 a trade lose about 20 basis points a week, which would be over 10% annually, while the large retail trades lose very little, maybe 1 basis point a week, which is not significant. Those are trades of over $10,000. And one of the reasons we think this is relevant is because, as I'll show later in the talk, these smaller trades tend to be placed by less wealthy and less experienced and less sophisticated investors. So the methodology, we basically adapt the methodology that was pioneered in Burmer, Jones, Zhang, and Zhang. Well, it's now 2021, the forthcoming paper. And we take a look at the TAC database, that's transaction and quote database from the New York Stock Exchange. It comes from the New York Stock Exchange, but it covers all the exchanges, all the trades on US stocks. And this gives second by second, or millisecond by millisecond quotes and trades. The algorithm used to predict, to identify stocks as retail trades is this. Retail trades in the US, if you place a trade with a retail brokerage firm like E-Trade or ATD, Ameritrade, or Robinhood, the trade is sold to a wholesaler such as Citadel. And the wholesalers, and when that trade shows up on the TAC, in the TAC database, it has the identification for exchange code D, which means that it was an off-exchange trade. And the wholesalers often give sub-penny order improvement. So that often is as little as 1/100th of a penny. And we can use that that sub-penny improvement to identify whether the trade was, if the order was a buy order or a sell order. So if the order is a sell order, then you expect the sub-penny improvement to be slightly higher than the nearest penny. So the sales order got a slight improvement compared to the prevailing best bid and national best bid and offer. And if it was a purchase, the sub-penny improvement will be generally slightly less than the penny. So in the range of 0.6 to 1 pennies. We do some standard filters, again, following Burma Jones, Zhang, and Zhang. We require a minimum of 10 retail trades in a stock on a day for that to be an observation. We limit the trade size to trades of under $100,000. If we include trades of over $100,000, it actually doesn't make a material difference. So why are we taking out trades of over $100,000? Basically, because Brad and I in particular are interested in welfare issues for retail investors, for ordinary investors. And in our opinion, most people who are placing trades of over $100,000 are probably wealthier than the ordinary investor that, whose welfare concerns us. We exclude a couple of periods where there were some tick size pilots being run by FINRA and the exchanges. Order imbalance. So the proportion, we look at the proportion of buys for stock. This would be the dollar value in purchases divided by the dollar value in trades, or dollar value of purchases divided by dollar value of purchases plus that of sales. So buys divided by buys plus sells. And then you can calculate the same thing on a particular day for the market-wide retail order imbalance. And so we standardize order imbalance by subtracting whatever the market order imbalance is on a day, and then standardizing by the standard deviation of a stock's order imbalance. So we'll find that what this has the effect that small stocks, where there are fewer trades, you're going to see much larger shifts in order imbalance, and standardizing gets away a little bit from that small sample effect. We measure abnormal trading volume by looking at a stock's trading volume in a day minus its average trading volume, the mean trading volume from 5 days previously back to 45 days previously, and then scaled by the standard deviation over that same period. So we're looking for days where a stock on the upside traded a lot more than it usually does. So it traded, and that's relative. So if the market is has higher trading in a particular day, we're adjusting for that change in the market I mean, okay, I should say, we're adjusting for we're actually adjusting for how much that stock usually trades. And then we're also adjusting for the variation with the standard deviation. All right, so here is some descriptive statistics. So Q1, Q2, Q3, Q4, and Q5. What is that? That's when you sort stocks daily based on the standardized order and balance, where Q1 are the stocks being most aggressively sold by, stocks with the biggest sell order imbalance on the day, and Q5 is the stocks with the biggest buy order imbalance. And so, let's see if this is working. Does not seem to. Okay, so here you can see the order imbalance naturally, because this is the sorting characteristic, it goes from negative up to positive. The next two lines are measuring the buy-sell imbalance, both by dollars and by number of trades. And there's some more information about the stocks. So let's see. So here's our first finding. Retail investor underperformance is concentrated in the stocks that they trade most heavily. So what we're doing here is we're sorting stocks into the 5 groups, the 5 quintiles, based on retail order imbalance. We're taking a long position in the stocks that were being with the buy side order imbalance, and a short position in the bottom quintile with the sell side order imbalance. However, we're splitting stocks into 2 groups, the 10% that had the most trading volume that day, and the 90% with less trading volume. And over in the graph here, you'll see that the stocks with high abnormal retail trading volume underperform over the next 5 days, while the other 90% of stocks with lower trading volume actually have a positive performance. Here is basically that same graph on panel C is the same graph, but we're breaking it up here into 2 groups. The first is looking at what happens in the top order imbalance quintile. That's panel A. Those are the stocks that were being bought. And we see that the stocks being bought with high trading volume do very badly over the next 5 days. And the other 90% with less trading volume do well, although not, by an order of, it's a lower magnitude, but they go up while the other ones underperform. Panel B looks at the stocks that were most heavily sold the day before on day 0. And again, the red line is the stocks with unusually high trading volume. Those do well, but those were the stocks that the investors were selling. So they heavily sold stocks that performed well for the next 5 days. And the stocks that they sold, but in lower volume, did poorly over the next 5 days. Now we look at, we do the calculation slightly differently. Now we sort stocks into those same 5 groups based on order imbalance. And we create an equal weighted we weight stocks equally and create a long short portfolio again. So we weight all the stocks in the top order imbalance quintile. We buy all of them, but weighting each of them equally. We sell all the stocks in the bottom order imbalance quintile, and we weight them equally in the portfolio. And that's what you get with this black line here. And you can see it has a positive performance over the next 5 days. And these are confidence intervals, so it's statistically significant. And that's consistent. That's basically what Bermer, Jones, Zhang, and Zhang find looking at the same data. And it's consistent with what other papers that looked at order imbalance and how it predicted short-term returns. It's consistent with what other papers have found. What's going on with the red line? Well, in the red line, we take those very same stocks. So we form a long portfolio of the same stocks, but instead of weighting each stock equally, we weight it by how heavily it was traded by the retail investors on the particular day. So actually, we're weighting the buy side by it's purchase weighted, and the sell quintile is sales weighted. So now we're weighting the stocks that the investors are buying by how heavily they bought them, and we're weighting the ones they sell by how heavily they were selling them. And now the portfolio loses money. It goes the other way. So this is now basically replicating showing you those same results that were 2 slides back on a table. So here again, we have each of these quintiles, 3, 4, 5. The low is the ones that stocks that investors are mostly selling. 5 is the ones that they are mostly buying. If you look at all stocks and you equally weight the portfolio, you see that the buys outperform the sells. And on a 1-day horizon, that's panel A, it's by 5.5 basis points. On a 5-day horizon, it's by 1.88 basis points, but that's daily. So you'd multiply that by 5. If, though, you split it up into the stocks, SARV D10 is the decile of stocks with the highest abnormal trading volume. The stocks the investors were buying most aggressively, trading most aggressively. And there you get the opposite effect. The stocks bought do badly. Well, the stocks sold, they don't do, well, they do much less badly. So if you go long the stocks bought and short the stocks sold, you end up with a negative performance of about 17 basis points on a daily basis, 10.5 over a 5-day horizon, which again, multiplied by 5 is going to put you up over 0.5%. And then the next slide, oops, missed one. Here's doing the same thing. And now instead of weighting every stock equally, we are actually, I'm sorry. I had conflated these slides. Here's the equal weighted performance. The performance is not quite as bad as what I said. Actually, my slides are moving. Sorry. We'll see if they stand still. When you equal weight, the less traded stocks, that long short portfolio earns about 6 basis points in a day, and the heavily traded stocks lose about 7.5. And it's similar, the magnitude, it's, well, multiplied by 5, the magnitudes are higher over 5 days. And these are the purchase weighted, which just accentuates the result. All right, here we have a regression. It's basically another way to show the same thing. The regression allows us to throw some controls in. So the dependent variable is the daily return for a stock. The independent variables are an indicator variable for which order imbalance quintile a stock was in, and an indicator variable for whether it was in the top decile for trading volume or one of the bottom 9 well, the indicator variable is for if it were in the top 10, otherwise it's in the bottom 9. The missing, these are all dummy variables, indicator variables. So the base case is a stock that is in the middle order imbalance quintile. So it was neither bought nor sold a lot and was in the bottom 90% of trading volume. So it was also not bought heavily. And you can see that if you look at these stocks down here, these are basically represent the returns on the stocks that were not traded unusually heavily, the 90% of stocks with less trading volume. And you can see that the stocks that were most heavily bought significantly outperform, and the ones that were most heavily sold significantly underperform. However, this result flips up here where we are only now looking at the stocks with high trading volume. And now you can see the stocks that were bought with high trading volume underperform, and the ones that were sold with high trading volume outperform. So those are the results that basically look at what happens in the day and the 5 days after retail investors buy or sell stocks. And to summarize again, what we find is that if you weight stocks equally, their trades positively forecast market returns or stock returns. But if you weight the stocks based on how much the retail investors themselves bought and sold, they lose money. Now, day of trade returns. Burrow Keneal and David Serre, one of my colleagues, looked at trades by 91,000 French retail investors and found that the day of trade losses were enough to offset subsequent gains. We look at this, and here what we are doing is, again, dividing stocks. We're sorting them into 5 groups based on the order imbalance in the day of trade. And we're separating out the 90% of stocks with ordinary trading volume and the 10% of stocks that had unusually high trading volume. And the red bar here is the intraday return. So, and these are just, this graph is, or this figure is just looking at buys. So that's the return from the time a stock was bought until the close of market that day. And you can see the intraday returns for the most heavily bought stocks are slightly negative, for the most heavily sold are slightly positive, but there isn't a lot going on. And the gray bars are here are the bid-ask spread. So that's the just looking at the quoted spread. When it comes to the heavily traded stocks, however, you see very big same-day losses for the stocks that were most aggressively being bought. So the stocks aggressively being bought tended to lose 15 basis points between the price at which they were bought and the close of market that day. So that contributes additionally to the losses that retail investors incur and actually get, although it doesn't affect the findings that we saw before getting to this slide, but it affects what the investors end up with. This is what's sort of a heat map, and what we're showing here is we have these 50 cells. So each of them have 2% of stocks in them each day. And again, they're sorted horizontally based on order imbalance and vertically based on abnormal trading volume, with the ones at the bottom having the most trading volume. But what we're interested in here is the percentage of all retail buys minus the percentage of all retail sells that show up in each of these cells. And what you can see is, so here is the order imbalance quintile 3. That's the one that's kind of in the middle. And there's almost no difference between the number of buys and the number of sells in this quintile. The buys and sells are relatively equal, which means that if you look at the performance of the aggregate portfolio of retail investors, the buys and sells are going to basically cancel out. They were buying about the same number of these stocks as they were selling. So it wouldn't really affect their returns starting on the next day. It would probably affect their returns on the same day because they'd be losing part of that spread on every trade. But it's not going to affect the returns starting the next day. Where the action is out here. These are the stocks most heavily bought, the stocks most heavily sold. And what you can see is that even though this cell up here, the red one, although it only has 2% of stocks, it accounts for a large amount of the difference in buying and in the buys minus sells. If you add up all of the percentages here, you'll see this is close to, it's like 35 or close to 40% of all the buy imbalance. The point is really a lot of the buying activity of the retail investors is showing up in this cell here. It's very nonlinear. All right. Now, there are two interesting questions here. Or I would say these results raise two questions. One is, why do the trades of retail investors positively predict returns when retail trading volume is? Retail investors negatively predict returns and lead to aggregate losses when trading volume is high. Let me look at the first one first. Now, I should say, we do not try to answer question one. Good reason for that, which is that's exactly the question that was being answered in Burmer, Jones, Zhang, and Zhang. So that's the question that they answered in their paper, and there's no point in us trying to replicate that answer. You can still see my slides, correct? Yeah. Okay. So we tried to address the second question, but let me tell you what the answers to the first question that people have given are. So Burmer, Jones, Zhang, and Zhang, they basically do the same analysis, but they only look at order imbalance with equal weighting, and they find that the order imbalance positively predicts future returns, and they try to decompose this positive return. And what they say is that through an empirical decomposition exercise, we attribute less than half of the predicted power of marketable retail order imbalances to the order imbalances persistence and potential liquidity provision by marketable retail investors' contrarian trading. The remainder of the predictive power, over half of it, is consistent with the hypothesis that the marketable retail order flow contains valuable information about future returns. And so what they're saying is about half of this seems to be informed trading. Half of it is a persistence in order flow that they don't explain, but they say is related to future returns. And half of it is half of the half is consistent with Kanil, Zar, and Titman's idea that retail investors make money in the short term by providing liquidity to institutional investors. Now, there's a recent paper that is a critique of the methodology that Burmer, Jones, Zhang, and Zhang developed, which is the methodology that we're using in this paper. It's basically at the moment, it's the only methodology I know that allows one to try to identify retail trades from the TAC trading data. And this recent critique writes, so Dehi, Bernhardt, Da, and Warachka, they show that the wholesalers, that's companies like Citadel that are buying order flow, they're sometimes called internalizers. They are more likely to internalize order flow when institutional demand is high. What does that mean? It means that if institutions are buying, the wholesalers, such as Citadel, are likely to fill more sell orders and give price improvement to more sell orders from retail investors. And that could lead to the observed imbalance in retail order flows that we're looking at. And thus the measure of retail order flow could be negatively correlated with institutional demand. And if the institutions are informed, that could lead to basically, if the institutions are temporarily sort of paying to buy liquidity, that could lead to a temporary positive returns for the retail investors. So I don't know. I just read that paper last week for the first time. Brad and I and Sheng Lin had talked about this issue. We were aware of the fact that the internalizers may vary in how they fill, but we just don't know how important it is from a magnitude point of view. Is this something that happens? Yes. How important it is, I don't yet know. It certainly doesn't account for all of the effect of retail order balance positively forecasting returns, because prior studies that have had this result used a different methodology. So the methodology can't be the whole story, but it might be part of the story. So the part of the question that we're interested in is, why do the trades of retail investors negatively predict returns and lead to aggregate losses when trading volume is high? And what we think is going on is that it's basically being driven by, it's attention-driven trading by retail investors. And Brad and I wrote a paper called All That Glitters that was published in 2008. And we asked a question in that paper. And the question he asked is, well, when retail investors buy a stock, how do they choose the stock? Because quite clearly, retail investors don't go searching through the thousands of stocks they could buy and studying each of them and deciding, oh yeah, that's the one I want. So what we thought is what probably happens is a stock catches their attention. They read about it. They hear someone talk about it on TV, a friend mentions it. And then they decide, do I like it or not? When it comes to selling, it's different because most retail investors, not all, but most only sell things they already own. And then they tend to have small portfolios. In the data we've looked at, retail investors have often had like 4 stocks in their portfolio. So attention is going to be affecting buying behavior much more than selling behavior. Investor will hear about something, it gets his attention. If he likes it, he buys it. If he hears it, when he decides what to sell, it's a much smaller search set. When he wants to sell, he only owns 4 stocks. He can say, do I want to sell A, B, C, or D? So we speculate in this paper that attention-based buying by individuals, because that attention-based buying is largely unrelated to fundamentals, it creates price pressure that is largely orthogonal to fundamentals. It pushes prices up and leads to negative post-purchase returns. So a bunch of individual investors buy the same stock on the same day. So our theory, and we developed that in the paper, was that individual investors as a group would be on the buy side of the market on attention-grabbing days, because attention would affect their buying but not their selling. So this would lead, the idea is a stock grab is the attention of individual investors. A bunch of them buy it. As they buy it, they push the price up, and subsequently the price comes back down. There are a number, so that paper was published 13 years ago, and there have been a lot of papers both before and after that have looked at attention-based buying or attention-induced effects on prices. Looking at Google searches, repeat news stories, the Wall Street Journal, the dartboard column, Jim Cramer's, he's a sort of television personality, his picks. And more recently, Brad Xinguang, Chris Schwartz, and I had a paper that's forthcoming in the Journal of Finance where we look at Robinhood traders. And we see the same phenomena in Robinhood. We look at about 0.5% of stock days. So basically, we're looking at the 0.5% of stocks on a particular day where there was the most buying activity by Robinhood investors. And the pattern we see is a big run up in prices and a subsequent drop. And the drop usually doesn't go back down to where the price began, but a lot of that buying takes place near the top. So the Robinhood investors as a group tend to be losing money. There we go. Oops, one slide too many. So the final question that we look at in this paper or ask is the poor performance of, well, first of all, I'm sorry, not the final, the second to last question. Is the poor performance of stocks heavily traded by retail investors an attention effect? And if it's an attention effect, you'd expect that investors, that attention-motivated investors are going to concentrate trades more in the high order imbalance, the high volume stocks. There'll be more herding in those stocks. We would expect that less sophisticated investors and less wealthy investors are going to be more attention motivated. And that's going to say that small trades, we know that small trades tend to be more likely placed by less sophisticated, less wealthy investors. So we'd expect small trades to be more concentrated in high attention stocks and to underperform larger trades. Oops. So first, we look at a data set that Brad and I have analyzed a number of times, retail traders at a large discount brokerage firm in the US. And we're just looking to see what what the correlation between trade size and the demographics of the investors. So we find that investors who have self-report less knowledge about investing tend to place smaller trades. Investors who self-report having less experience tend to trade smaller trades. Investors with less wealth tend to trade smaller trades, and investors with less income tend to trade smaller trades. And that's at a large discount brokerage firm. So that's different data than the TAC data that I've been talking about throughout the rest of the talk. Now going back to the TAC data, we look at the distribution of the number of trades that we see and the value of trades. And what you see, not surprisingly, is that there are a lot of trades for less than $500. There are probably 6 times as many trades for less than $500 than trades of over $100,000. And so that's the black line. This is the number of trades. Where you see the most number of trades is in this $2,000 to $10,000 range. And this again is in the transaction data, the TAC data. not too surprising though. There's a lot more value in, oops, sorry. I don't know why that happens, in the largest trades. So this is where, this is where the small investors are, the retail investors. And what do we find? First of all, we see that if you sort trades based on trade size, and then you look at the concentration of trades in the high attention stocks. So those are the stocks that are in the buy quintile and the top trading volume decile. You see that the stocks of the smallest trade size are the most highly concentrated, and these are their buys, and that the larger trades are less concentrated. And that's consistent with this idea that the small investors are more swayed by attention, and the large investors are probably more swayed by fundamentals and other things that matter. Now we look at performance by trade size. The blue bars are a one-day holding period. The red bars are over a 5-day holding period. And you can see the trades of under $500. And this is starting the day after the trade. So this is not affected by the bid-ask spread. And none of the calculations I'm talking about today include commissions. Okay, so if an investor is paying commissions, that's certainly hurting their return beyond what we're talking about here. So basically, just in terms of sort of like predictive power, the smallest trades do the worst, and by far, like substantially worse. And that's starting the next day. So that's not the spread. They are doing worse. So in conclusion, retail trades can be analyzed to positively predict short-term returns. We know how to do it. Many studies have done it. You sort stocks based on order and balance, daily, weekly, even monthly. And you get a positive relationship between past order and balance and future short-term returns. Nevertheless, retail traders earn in their own portfolios negative short-term returns. The reason for this is that the retail investor underperformance is concentrated in the stocks that they buy most actively. So they're doing most of their trading in the stocks where they do worst. And we think that these are the stocks that are likely to be being bought because they've caught the attention of investors. And these are investors who are swayed by intention rather than being swayed by, say, fundamentals. These investors aren't doing a discounted cash flow analysis. On the day of the trade and over the next 5 days, these high attention stocks perform worse than other stocks, and it's less wealthy, less sophisticated investors who concentrate buying most heavily in high attention stocks, and they earn lower returns than other investors. And I think I came pretty close to ending after the hour. So that's the, I'll stop sharing there. Those are my prepared remarks, but happy to talk, answer questions, try to.
Okay. Well, thank you very much, Professor Odean. It's very, very interesting and very informative presentation.
Yeah, I'm sorry, it's a little bit technical. I understand. I tried to go slowly, but I know that there's a lot. For people who don't work in this area, it may have been a little bit boring at times. Sorry.
No, not at all. It's very interesting. Okay, ladies and gentlemen, now come to the question and answer session. If you want to post any question, please chat on the box below. And don't forget to mention your name and institution. I will choose 3 first questions. And if there is still time left, I will select some additional questions. Okay, please post your question from in the chat on the chat below. Maybe while waiting the others to post the question, I have a question for you, Professor.
Sure.
Yeah. You said that attention motivated buying creates a price pressure, right? And also that retail investor is positively predict future returns. Is it any relationship of that? Is it the positive return is caused by the attention motivated of buying?
No, actually, so in this study, no. So what we'd find is the positive returns associated with the attention buying, they actually show up, and I didn't put this up because we haven't put it in the paper yet, but they show up on the day that the buying takes place. So if you look at the return from the close of the day before to the point at which the retail investor buys a stock, that return on average for the high attention stocks, for the ones that are in, that heavy trading and buying, that return is almost 1.5%. So that buying activity drives the price up. And then when we see those stocks underperform over the next 5 days, that's the downward drift. So the analogy in our Robinhood paper would be, on the day that we see retail investors, not retail, but Robinhood investors buying a stock, there tends to be a big spike in the price, sometimes ridiculously high, like, wow. And then over the next few days, those stocks lose money. So we think it's the same thing, that retail investors get excited by, a lot of them get excited by a few stocks. So you see big piling in, and especially lately, there's been that sort of retail investor frenzy for the last couple of years. So these people pile in, they drive the price up, and then the price subsequently comes down. As I said, it often doesn't come down as far as it'd gone up, but a lot of that buying activity takes place at a very high price. So in the Robinhood sample, we estimated that while some of the investors at Robinhood undoubtedly made money during these episodes, as a group, they lost money.
Okay, thank you, Professor Odean. We have one question from the participants.
Can I?
From Silvana Shah.
Yes.
Yeah.
Thank you.
You can post your question directly to Professor Odean.
It is a great honor to meet you, sir. I have watched several lectures from you and on YouTube, and right now I'm one of your fans.
Oh.
Okay.
Allow me to introduce myself. My name is Silvana Shah. I'm from Management of Science Department in PhD studies. And at recent, I study in finance. I have read your paper, and it is so amazing, and so many mathematical and statistical on there. And you said about Robinhood's trading app Spurs investor herding instinct. Could you please elaborate more?
I'd be happy to talk about that. All right. So there's a few things going on with Robinhood. And all of this is sort of relevant to the paper I presented just now in terms of motivation, like what's driving people. But Robinhood is it's the same activity, but maybe even more so. So Robinhood has a lot of inexperienced investors. This was documented in the New York Times. They have, I forget the exact percentage right now, but a lot of their investors had not invested before going to Robinhood. And a few other things is on Robinhood actually makes it feel like you're playing a game. They've cut back on that. It used to be, I opened the Robinhood account so I could have the experience that I was writing about. And I was sort of surprised. It was so easy to trade. I set up my account in 5 minutes. I transferred $500 from my bank. And I thought, well, in 4 days or so, I'll be able to trade when the money clears. Robinhood let me start trading immediately. I did the same thing at E-Trade, and E-Trade said, well, you can start trading when your money comes in. But Robinhood, right away, I could start trading. I placed a trade, and on my phone, there was this sort of like digital confetti, like, yay, you placed a trade. Yay, how exciting. So there was this sense of sort of excitement. It's extremely easy to trade. Now, I wrote a paper many years ago with Brad Barber about online trading when online trading was new. And what we found was that when people switched from telephone-based to computer-based trading, they traded more. And not just for the first month, which is, you have a new toy, you want to play with your toy. But when you looked months later, you'd see that people who'd switched to online trading were trading more actively. And one reason for that is probably it's easier. E-Trade had an ad years ago. I used to play this to my students. And it said, it's 2 o'clock in the morning, and you want to place a trade for that fast-moving stock you've been following without waking your baby or your broker. It's time for E-Trade. And so the idea is, well, wow, you can trade at 2 in the morning. What I told my students was, if you wake up at 2 in the morning with a brilliant idea or in a cold panic, don't trade. Go back to sleep. Yeah. It's too easy. It's not good sometimes for something to be too easy. It makes it easier to be impulsive. So the Easy app, now another thing we talk about on Robinhood is the app is so simple. Unlike other brokerage firms that sometimes give you lots of information. I know Morningstar is not a brokerage firm, but if you go on Morningstar, there's a lot of information. On Robinhood, there's much less information, and thus it's less intimidating. You don't, maybe a naive investor, if they go on a website and they see a lot of statistics they don't understand, they say, oh, maybe I shouldn't be doing this. But when they go on Robinhood, they see things like, oh, which stocks are other people at Robinhood buying today? I think I'll buy those. So, and we also think that's one of the coordinating factors on Robinhood is they have a few short lists, and the lists direct people's attention to the same stocks. However, another factor that's not directly connected to Robinhood, but relates to it, is that there are now chat boards, on Reddit and other places, like Wall Street Bets, where retail investors sort of talk to each other and can coordinate what they're doing. And that's probably heightening these attention-driven buying frenzies.
Oh, awesome. Thank you, Prof. Thank you.
Thank you, Mrs. Silvana, and thanks, Prof. Odean, for the answer.
So the one thing that I think Silvana said she saw some of my videos on YouTube. I actually do have a lot. They're not about my research so much. They're about, I teach personal finance. So I have a bunch of videos about investing and stuff like that. If anyone's interested, they're free. I don't make any money off of it. I use them in my classes. But.
Awesome. Thank you.
Okay, Terry, I would like to ask 2 questions.
Okay, who is that? Okay, Prof.
Okay.
Pak Herman.
Based on your research findings, so that retail investors lose their money in when they trade, right? So my first question, what should the retail investor better do so that they can gain from their trading?
All right, there are a few choices. And the answer, in a way, the answer depends on where you are and when you're there. So what I teach my students here now in the US is to buy inexpensive index funds. So I say, go to Vanguard and buy the S&P 500 or the all market index fund. The fees are extremely low, and you will basically get the market return. And I think that's currently still good advice in the US. Index funds are not perfect, but they're probably better than the average investor is going to do on his own. You get diversification and you get low fees. Now, if an investor's in a country where there is less price efficiency, and I'm not claiming the US is highly price efficient. Right now, I think prices are a little crazy in the US. But if you were in a country where there was less price efficiency, you might consider investing in an actively managed fund if there were a manager who was doing careful analysis of the value of companies and not charging you too much. So the markets you can't, as people have pointed out, you can't have a market that's all people buying index funds, because then there's no price discovery. The argument for buying an index fund in the US is there's too much money being spent on price discovery already. Some of you may know the Grossman-Stiglitz paper that shows that there should be an equilibrium between passive and active investors. Some people, you might say, well, why not do your own analysis? For most people, it's too hard and they don't have the time. Some people can. Some people, I'm sure many of the people listening to this talk know how to read financial statements and do discounted cash flow analysis. And as long as you remember to stay diversified, you may do okay, especially in markets that have a lot of inefficiencies. But I can't advise, I couldn't tell these traders on Robinhood who have no idea what a discounted cash flow analysis is, that they should be doing their own research. I mean, it's too much. They should be probably being passive investors. The other advice I give, and I tell my students this, I say, look, if you really enjoy trading, that's fine, but don't do it with your retirement savings. Take some amount of money that you can afford to play with and say to yourself, I'm doing this instead of going to Las Vegas. That's fine. There's nothing wrong with that, but separate out serious investing for retirement from entertaining yourself.
Okay, thank you, Teddy. Last question about the retail investor characteristics, such as finance and accounting background versus non-finance accounting background, and also gender, female versus male, and also young and versus old. Is that possible? Do those affect the level of
yes,
loss of the trading?
Okay. In this paper, I don't know because I don't have that information. I'm working on another paper. I don't know if you know, there's a company, eToro, and they're all over the world. And they have a lot of active traders. And a couple of other co-authors and I are looking at eToro trades. I just got the results yesterday. Like, we don't have the paper written yet, but soon. And what we're interested in is how people respond to when eToro went to zero commission, how it affected people's trading. And what we found was, along the dimensions you just mentioned, there were big differences. We found that the people with a finance background didn't change their trading as much as the people who didn't have a finance background. The people who didn't have a finance background started trading more actively when the commission went to zero. Men started trading more actively when the commission went to zero. Women didn't react as strongly. Younger people reacted more strongly. So that's all consistent with what you're saying. You know, in this study that I presented today, I just don't have the data. Of course, I've done studies looking at the retail brokerage firm that Brad and I and others have studied over the years. And we also found that men traded too aggressively compared to women. Younger people traded more aggressively than older people. We didn't have a finance background as one of our demographic characteristics there, but I bet if we had had it, we would have found a consistent finding.
Thank you very much, Terry.
You're welcome.
Thank you, Pak Herman, for the questions and Professor Odean for the answer. And we have next question from Miss Salina from S3 Ilmu Manajemen Keuangan. Miss Salina, have you joined us? Miss Salina? Okay, okay, I will. Okay.
Oh, she's driving. I see her question. No, don't join us if you're driving.
Yes, yes.
I don't want to cause any accidents. Thank you.
Okay, I will read the question, maybe,
yeah.
Prof. Odean. Okay. What are the stark difference between individual investors and institutional investors in companies on each continent? Many thanks.
All right. It's a little hard because I can speak, I can speak with some expertise about the things I've studied. So in the US, as we're seeing, the institutional investors tend to make money and the retail investors tend to lose money through active trading. Now, that doesn't mean all institutional investors are making money, but in general, the institutional investors, the institutional investors tend to do that which I was talking about, which is they analyze companies. They do discounted cash flow analysis. They read the, they read the annual reports. They go through the financial statements. On average, that leads to better outcomes. Now, I should also say there are some institutional investors who play a different game and try to ride trends. They try to like surf the wave before it crashes. So not all institutional investors are taking a Graham and Dodd style or Warren Buffett style approach to investing, a value sort of style of investing. But in the US, institutional investors are generally coming out ahead of the individuals. I did a study, it was cited here, but is Barber, Lee Liu, and Odean of every investor in Taiwan over a 5-year period. And we were fortunate to have data from the Taiwan Stock Exchange that allowed us to identify investors as individuals and institutions. Now, the Taiwanese investors trade very actively, and they trade much more actively than most US investors. Found was that there were 3 sources of losses to the Taiwanese investors. There were the trading losses, which would be when an individual, say, sold a stock to an institution or bought a stock from an institution. The stocks sold to institutions tended to go on to do better, and the ones bought from institutions tended to go on to do not as well. And most of the effect showed up in the first 6 months. There were also commissions charged in Taiwan, and at the time there was a transactions tax, which in the US we don't have. And then there were market timing effects. So if we looked at a period, like if there was a month where the individuals as a group put more money in the market, on average, the market did less well over the next 6 months. And if the individuals were taking money out and institutions were putting money in, it went the other way. What we found, and this is extreme, I'm not claiming you would find this elsewhere, although there are probably a few countries where you would, was that the aggregate losses of the individual investors, when you added up the commissions, the transactions tax, the trading losses, and the market timing losses, were about 2% of GDP. So it's a lot. And if you want to put it in percentage terms or return, it amounted to, I think it was about 3.7% return over the next year. Might even been close to 4. I haven't reread the paper in a while, but it was somewhere in the neighborhood of 3.7% return annually. So I can safely say in Taiwan during our sample period, the individuals were doing very badly compared to the institutions. Europe, well, let's go up to Canada. The problem in Canada is that the advisors charge too much money and the mutual funds charge too much money. So there's almost no cheap way to invest in Canada. It's starting to change, but the mutual fund fees are still too high. You know, Robinhood, their motto is to democratize investing for all. They're not the people who did that. The person who did that was Jack Bogle, who started Vanguard, because Jack Bogle made it possible to have a $10,000 investment in the S&P 500 and only be paying $3 or $4 a year in a management fee. What Robinhood has done, if anything, is democratized trading for all. They've made it very, very easy to trade. But in my mind, there's a difference between investing and active trading. Europe, I think you find the same thing in Europe. I just haven't done, I don't know of the studies, but I think you would find that the institutions are doing better than the individuals and that there's a lot being charged in fees. A lot of European individual investors buy these structured products that are very poorly priced and probably shouldn't be sold. China, I cited that recent paper with Jones, Zhang and Zhang. They are finding that the retail investors over a short horizon, at least, are doing poorly. I have seen some studies done in India. I don't know of a country where the individuals are consistently doing better than the institutions. It's just a question of degree. I don't hear you now.
Now? Can you hear me?
Now I hear you.
Okay.
Now I do.
Okay, thank you for the answer. We still have 9 minutes. Do you have any question, participants? Yeah. Next question from Mr. Muhammad Irsyad. Mr. Muhammad Irsyad, have you joined us?
Yes, I'm joining.
Okay. You can ask directly to Professor Odean.
Okay, nice to see you, sir, Prof. Odean. I want to ask in previous questions, in efficient country, do we avoid choosing stock based on trending or drive information by an opinion leader, which lead to a concentration of large volume of buying that you say many of lose caused by many concentration of buying in high volume in quantile 5 that you mentioned before. So what we should do if I'm a risk avoid investors retail, it means that we have to choose the mutual fund manager to give my funds or something like that. Okay.
I know it's a tough one. So I would recommend you become one of those opinion leaders, and then people can follow you and you'll make money. But assuming you can't pull that off, that does leave you with the questions here. So I can discuss the problem. I don't know what the answer is. On the one hand, if you went to a mutual fund manager and one of the problems with going to, if you tell individuals to go to a mutual fund manager, almost always they're going to go choose the manager who did really well the year before. So they're just chasing, instead of chasing a stock, they'll chase a manager. What you want would be a manager, you know, you'd have to know enough about finance to know that the manager was making what you thought were sensible decisions. You would have to, you know, ascertain the manager wasn't charging you so much money that it was no longer worth it. And you'd have to be patient. So a friend of mine was an academic, Joseph Lakanashak. He was the chair at the University of Illinois and really well published. And he went into money management. He eventually, you know, quit his job at the university and became a money manager. And I know he was a fundamentals, you know, study the market kind of guy. Very smart and very straightforward. And in the late 90s, when the dot-com bubble came, his company almost didn't survive because he was buying things that were where the prices made sense, but the market wasn't listening. Now, eventually, you know, things turned around and he did very well, as did, you know, people like Warren Buffett. But you do run the risk that the market isn't going to pay attention to the numbers for a while. I used to tell a story about in the late 90s, 98, 99, where there were two big investors, Julian Robertson, who was running something called the Tiger Fund, and George Soros's fund, which was being run by, oh goodness, I'll think of his name in a moment, Stanley Miller. I'm sorry, his name is eluding me. But Julian Robertson decided that all these high-tech stocks were overvalued, and he basically pulled out of the high-tech sector, and the market went way up. He pulled out in the summer of '99, and the market went, that part of the market went up, and his investors were leaving him, and he closed his fund in March of 2000, right before the market turned. And Stanley Druckenmiller, was running George Soros's fund, and he went long these stocks. He went long the high-tech stocks. And then the market turned and he lost a bunch of money. He was quoted in the New York Times, and he used a baseball analogy. He said, "We knew the market was overvalued. We thought it was the 8th inning. It turns out it was the 9th. What that means is we thought the game was going to last a little longer, but it ended before we were ready." So if you're going to decide that you're going to buy things that you think are overpriced because other people are going to buy them after you, it's a tricky game. It can be done, but it's a tricky game.
Okay, nice. Thank you, Prof.
Welcome.
Odean.
Thank you, Mr. Muhammad Irsyad, for the question, and thank you, Professor, for the answer. As we still have 3 minutes, maybe last question. Do you still have any question, participants? Okay, if okay, I think there's no more question. Prof. Odean, may we close the session now? Okay.
Sure. Thank you so much. I really appreciate this opportunity to meet many of you and, you know.
Okay, thank you, Professor Odean. Okay, next, we have to move to the next agenda. Before we end this seminar, I remind you to fill in the attendance confirmation form on the links below, shared on the chat box. And now we will take a picture together. I think I need help from the operator, Miss Nur Sarfitri or Miss Esther. Are you ready to take our photo?
Yeah, Miss Titis.
Okay, Miss Nur. Okay, could you please give us a comment, right, to take the photos?
You please to send again the link.
Okay.
Okay. Have you done, Miss Nur?
Okay. Before I start, please. Okay. Before I start, please turn on your camera first, the audiences. The first slide, because there are. Okay, for the next slide. Okay, for the last slide. 1, 2, 3. Okay, Miss Titis, I think it's done. Thank you.
Thank you so much, Miss Nur. Okay, ladies and gentlemen, before I close the seminar, I would like to take the conclusion from what the speaker has presented. First, there is a paradox experienced by the retail investors. At short horizons, the order imbalance of retail investor positively predicts future returns, and at short horizon, also retail investors lose money through trading. Second, retail investors' underperformance is concentrated in the stocks they buy most actively. In example, on a high attention stocks. Third, on the day of trade and over the next 5 days, this high attention stock perform worse than other stocks. And the less wealthy, less sophisticated investors concentrate buying most heavily in high attention stock and earn lower return than the other investors. Okay, ladies and gentlemen, then we finally come to the end of this seminar. I'd like to thank the speaker for the informative and interesting presentation and all the participants for the very active participation. I also thanks to the committee who have organized this wonderful event. And finally, please give the applause for the speaker and for you all.
Terry, thank you so much, Terry.
Okay,
Thank
good
you.
afternoon.
Thank you, Professor Odean.
See you on the next event. Thank you, Professor Terrance Odean.
Professor Terrance Odean.
Thank you.
Thank you, participants.
May I leave now? Thank you. Bye.
Yes. You may leave the room.
On a summer evening. It's I want more.